Hey, I don't know about you, but I just love that 30-second countdown. I kind of do a little shaking and jiving here. It is Thursday afternoon. You're with us on Mortgage Minute. My name is Jeff Harrison. And in a few minutes, we're going to talk a little bit more about what's going on in the marketplace. But I'm excited because, normally when I see things falling, I'm usually getting in trouble because I've broken something. Today, Art is going to share some things that when the things are falling, we see people getting excited and taking action. With that, I'm going to bring Art in. Hey, it is Art Alvarez with MortgageWorks. Art, welcome.
Hi, Jeff. How are you?
I'm fantastic. I'm so excited. I just love looking at the market starting around 5:30 in the morning and seeing what's going on.
Yeah.
And it just sets my tone for the whole day when I see good news.
Yeah. No, you're right. I do the same thing. And it's definitely been a jubilant week in the markets, which we'll talk about in a minute.
Well, I know not only are you going to talk about some exciting news and what's going on in the marketplace, the things that are driving that, but I want to point out you have a guest today, and you're going to invite him on. I'm not going to spoil or take any thunder because he is a man that brings his own thunder. But I do want to point out, if you're watching the show live, I'll be in the background, and if you have questions or comments for Art or his guest, please put them in the comments section, whether on YouTube or Facebook, and I'll feed them forward. And if you're watching this after the fact, then do the same thing, and Art and his guests will also chime in. So with that, Art, I'm going to turn it over to you. Just have a great show.
Okay. Thanks, Jeff. Hello, everyone. Welcome to the show this week. My name is Art Alvarez. I'm with MortgageWorks, where we do have the answers and they're on the house. And as Jeff alluded to, we do have a special guest today, which we're going to bring him on in just a minute. But first, I want to give you our usual weekly market update in terms of both the bond market and mortgage rates. So let's get right into that. Here's our current rate grid, and you'll see some really good news on here because guess what? We're back in the sixes on various loan programs, both conforming fixed rate loans, 15 and 30 year, as well as FHA, VA, all back in the sixes, which is interesting. I'll remind you again that in the news media and the talking about the markets and mortgage rates, I'm still hearing about how we're now back under 8 and in the mid 7s. Well, we never got to 8 at MortgageWorks. We were able to still hang on to conforming loans under 8 all through this recent period. And now we're dipping back below 7. So just keep that in mind when you're hearing all these stories about where rates are at. So what happened this week to cause this improvement that we were happy to see? Well, first, let's take a look at that bond chart. There's the chart that Jeff just pulled up, showing you the change in yield over the last 5 days since last Friday. And you can see going back to Tuesday when we had the big drop in yield. And that was very interesting because on Tuesday, when that big drop in yield occurred, the markets really celebrated. The Dow Jones Industrial Average went up over 500 points. And in no time, we were seeing news feeds about the fact that, this is going to continue and rates are finally going to start going down. Well, I guess, of course, that continued on Wednesday. And then we had a little bit of an uptick today and then back down. So I'll go ahead and get into that here in just a second. So why did this happen? Well, this week, really, it was all about the inflation numbers. Both the CPI, that's the Consumer Price Index, and the PPI, the Producer Price Index, were released this week. And CPI was first, and that's what caused this market celebration and the 500-point gain in the Dow. It came out at 3.2%, slightly below forecast, and below what we had in September of 3.7. So 3.2% year over year. That's what looks like yo-yo is. That's year over year. And the markets just went ballistic, happy about the fact that they had come in below expectation by just 0.1%. But, it's interesting because I'll remind you that 3.2, while much better than we've seen, it's still above the Fed's inflation target. And then we saw additional or further improvement on the Producer Price Index. The PPI also came in 2.9% year over year versus 3 in September. That was also better than forecast. And so you can see there I have a bullet point about, the market celebrated. But what do I mean by that? Well, again, it was interesting. The jubilation was wide and strong. UBS, for example, that's the Swiss bank, they've already published an announcement where they're predicting that the Fed funds rate may be dropped multiple times next year by a total of 2.75%. That's a pretty strong prediction. Most of the other observers, major banks like Bank of America, the Mortgage Bankers Association, National Association of Realtors, I will tell you, they're still kind of hedging that rates are going to get better going into next year, but still probably in the sixes at best, maybe get to low sixes by the end of the year. So in that regard, I would just point out that despite all the jubilation, we still have a ways to go. In fact, the current 10-year bond yield level, this 440, 443, 444 range, we were there just 60 days ago. And yet 60 days ago, we didn't see quite this jubilation that we're seeing now. And I'll remind you, it was only about 7 months ago that the 10-year bond yield was only 3.25. So under 4.5, that's great news, obviously. But I just want to temper your expectations that we do still have a little bit of a ways to go. What came out today also helped the bond yield, because actually yesterday, after this CPI and PPI came out and we got into the mid 440, 445 range, the 10-year went back up closer to 355 yesterday, and now it's back down again. Why? Because industrial production came out minus 0.6%. 0.4% is what it was in September. So that's further weakening, which again is good news to the bond market, the bond traders. And so that's why we're seeing the bond yield again back in the under 4.5% range. So we'll see what happens next week. It's a short week, Thanksgiving week. Probably not going to be much going on in terms of changes to bond yields. So we'll just have to see how that goes. So now I want to go ahead and jump into our Q&A session. And again, I'm pretty excited to announce that we have a guest. Somebody I know, I've gotten to know pretty well. His name's Aaron Huebner. He's with a company called the Ascent Network. And I brought him on the show because I want to talk a little bit and, kind of pick Aaron's brain and help provide you, the viewers, some more information, better information on issues regarding credit scores, credit education, credit reports. So with that, I want to go ahead and bring Aaron onto the show here. Hi, Aaron. Welcome to Mortgage Minute.
Art, thanks for having me. I appreciate it.
And Aaron, if you could, real quick, before I start firing off questions to you, can you tell us a little bit about the Ascent Network, what kind of company it is, and what kind of services you provide?
Sure, be happy to. I started the Ascent Network back in 2009. Our primary and foundational type of product is credit repair, credit restoration, credit score improvement. I wanted to do it a little bit different, even though I've been in the credit repair business for 35 years, and this is my third company that I've owned. I wanted to do it a little bit different this time, and so what I chose to do was I chose to start Ascent on a nonprofit platform. So we are a nonprofit, 501c3 nonprofit organization. We're registered in all 50 states, plus the District of Columbia. We currently have open and active files in 38 of those states.
Well, great. And actually, I'll just tell the viewers real quick, I've been in the mortgage business for a long time, as you all know. And over the years, I've been approached by a lot of folks who are in the business that Aaron is in. And I have generally shied away from them, mostly because I couldn't find anyone who I felt comfortable with, that they could really deliver on what they promised in terms of helping people with credit restoration, credit scores, credit score improvement. And when I met Aaron and got to know more about him and his company, what I learned is that he and his company, they're different. They're for real. They're legitimate. And I have gotten to a comfort level where I am happy to refer people to Aaron who are having some challenges with credit score that may be an obstacle with them getting a loan when they meet me and I'm trying to get them pre-qualified and I find out that they've got some challenges. I will readily refer those people to Aaron because I'm comfortable that what he's doing is legitimate. I believe he does it at a pretty reasonable cost. I think he knows how to inform these people in a realistic way about what's going to happen, what they can do to help that borrower, how long it's going to take. And I've seen the results. I've actually had somebody people who I've referred to Aaron, and he's been able to get their scores up, and then I've been able to successfully arrange a loan for them. So that's part of the reason I have Aaron on the show. So with that, I want to jump into my first question. And this is a question that I had to ask because I run into it all the time. And that has to do with when I'm first encountering a borrower, they want to get pre-qualified. I let them know that part of that process is I'm going to pull their credit report. And there is just, in my opinion, just an inordinate fear by consumers, by prospective borrowers, of having their credit report pulled. They're just very fearful that that's going to crater their credit score. So, Aaron, can you comment on that and tell me and tell our viewers really what's going on there? Is pulling a credit report to get qualified for a mortgage, is that really going to be that damaging to their score?
Well, like with most answers dealing with financial things and so forth, the answer is it depends. But the individual that comes to the Mortgage Works seeks out a particular mortgage professional or lender and runs a credit report, and that lender is able to use it with all of their all of the companies that they might be investigating, or if they're just representing one company, they're going to use that particular report that loan originator pulled. Then the answer is no, it's not going to have an adverse effect at all. Here's why I can say that with certainty. There are a number of different types of reasons that credit reports are pulled. And the credit bureaus, in conjunction with the Fair Isaac Corporation, FICO, they have developed a lot of different algorithms that they use depending on who and why is requesting a credit report. Now, some people or some companies that pull credit reports, retail companies, for example, you walk into a Macy's department store and the sales rep offers you 15% off of your purchase that day if you open a Macy's account. Mm-hmm. They pull a hard credit report, and the algorithm that's used immediately dings your credit report, and that has a negative connotation. You walk into an automobile dealership, and the credit bureaus and FICO understand and know that most people don't walk into an automobile dealership, negotiate with one salesman at one dealership, and apply one time for an automobile loan. So they cut them some slack as far as hard credit pulls that are pulled for the purpose of purchasing an automobile. Mm-hmm. What kind of slack are they offered? You can have five different hard pulls within a 60-day window of time if they're pulled for the purpose of an automobile loan. Now, when we talk about real estate, that's kind of the same idea. Although the frequency, one would hope, and I'm sure you have run into clients that that's not been the case, but you would hope they may shop you a little bit, but they're going to call maybe 1, 2, maybe 3 different places with mm-hmm. regards to getting rates and what they could qualify for for a mortgage loan. So in the case of mortgages, the consumer is allowed three pulls within that same 60-day window mm-hmm. without it having a negative impact on their credit score. So it really depends. If you're out there trying to get credit cards, yeah, each one of those inquiries, those hard pulls, are going to have a negative impact on you. If you're out there trying to get an automobile loan and you go to 1, 2, maybe 3 different dealerships, and then you settle on a vehicle you're going to purchase, there's no harm there. If you go to 1, 2, maybe 3 different people for mortgage help, there's not going to be a negative there. So the individual that comes to you, Art, and says, I don't want you to pull a credit report, well, they're really, you can educate them. Right. And by educating them, you can simply tell them, how are we going to underwrite your file? and no, Credit Karma does not work. My free credit report does not work.
Right.
But we're going to educate them. And at that point, you can school them to the point where they understand, hopefully, that you pulling their credit report is not going to have a negative impact.
Well, that's good. I'm glad to hear what you're saying, because actually you're validating what I have told prospective borrowers for a long time. And one of the things we can do is we can do a soft pull credit report to address their fear of a hard pull inquiry. But I always have to point out to the borrower that for what we do to really fully pre-qualify them, I need the hard pull, because that's needed, for things like the underwriting, automated underwriting systems called DU, LPA. And we can't use those with a soft pull. We have to use a hard pull report. So,
Exactly.
So this is good information. You're validating what I've been telling people. So I'm happy to know that I've been giving them good information. So with that, I want to bring up another issue that I run into again all the time when I am encountering a prospective new mortgage borrower. And I'll usually ask them if they have any idea what their credit scores might be before I actually pull their report. And they'll give me a number. And then when I pull their report, in some cases, all cases, they're usually surprised that the scores that we get on the report I pull are going to be different than what they tell me they think their score is. Sometimes the scores I get are better, but sometimes they're worse. That's where they get disappointed. So why is that? Why is it that a borrower may think they have a credit score at a certain level, but when I pull a mortgage report, it's a different number, and they're very puzzled why? So give us some insight as to why that happens.
Well, everybody thinks, and on the surface, you would assume that the credit reporting business should be a very easy and simple business. It's data in, data out. Like anything else, it's never that simple. It is data in and data out, but depending on, I mentioned it and I alluded to it in my previous answer, depending on why the credit report is being pulled, an individual can go into 3 different institutions over the course of the same day. They can start in the morning by going to their local credit union and applying for a Visa card. The credit union is going to pull their credit. Let's say they have a credit score of 680. And they hand them that, they say, good news, we can approve you for your $2,500, $5,000 credit line on your Visa card. Client's saying, fantastic. I'm going to see if this day continues to go well. They go and they sit down at the automobile dealership. And they apply, they find the car they want, and they go in and they apply. And that 680 credit score now all of a sudden is reading 667. Same day, 2 hours later. They still get approved for the car, but they're kind of questioning, that's weird. How did my credit score drop, almost 20 points in 2 hours? In the afternoon, they come see Art. And they say, we want to put a pool in our backyard, so we want to apply for a HELOC. And we need a $100,000 HELOC loan. Art says, let's get you pre-qualified. They sit down, fill out the application. Now, it's only 5-6 hours since that first credit report was run. Now the score comes back 643. And the client at this point in time throws up his hands and says, I don't get it. I don't get it. First of all, I thought my score was in the 700s. But then this morning when I went to my credit union, they said it was 680. Then I went and purchased a car and it was in the 660s. And now you're telling me it's not even, I can't even qualify for the HELOC that I want to get at the rate I want. What gives? Well, again, I alluded to it earlier. There's 28 different algorithms that the credit bureaus use. And depending on why that credit report is pulled, you're going to get potentially a different score for each one of those algorithms. So as a result, it just depends on what you are having your credit pulled for. And most importantly, always look at things like Credit Karma, myfreecreditreport.com, annualcreditreport.com, all of the free profiles you get, even if you get them directly from the credit bureau, TransUnion, Equifax, or Experian, are offering. Look at them simply as a guideline. Do not use the numbers they're giving you, because if you read the fine print, the small print, a lot of times they're not even using a FICO related score at all. They're using their own version, so they don't have to pay FICO for a generated score. So only deal with FICOs, and the only true score that matters is a tri-merge mortgage credit report, because it's the most complete, most comprehensive credit report that a client can get. And that's the credit report you pull when you pre-qualify someone for a loan.
That's correct. Yeah. And that's good to know and good to share with our viewers. And yes, good tip to always read the fine print, because I didn't even know that some of those, like you mentioned, Credit Karma, et cetera, may not even be using FICO at all and using their own proprietary scoring models, which of course can be way off. So that's really good to know. You know, I've heard you speak before about your company and the success you have with credit restoration, credit repair, and improving people's credit scores. I believe you've mentioned recently that you kind of reviewed all the clients and that you've done and over the past year, and that your average improvement in score is I think well over 100 points. That's really, really good. Can you kind of explain to the viewers or give them ideas about, or give them some idea as to what, if they are looking to get that kind of improvement, what's involved in the process? And what I really mean by that, what is a reasonable expectation if somebody approaches your company and they want to use your services? What is a reasonable expectation as to the time period it's going to take for them to see that kind of improvement? The reason I bring that up, and you may know this here locally, I've been hearing radio ads lately about, there's a guy out there, I think his name's Ray, and he's on the radio and he's talking about he can get your score to 750 in like a month. And I hear that and I kind of chuckle to myself. I cannot believe that that's legitimate, for real, and even remotely possible. So can you speak to that and give our viewers really the true picture of what it's going to take in terms of timeline to get that kind of improvement?
Yeah,
you know, on average.
Sure. It's really, really sad, to be quite honest with you, because most people, when they call me, when they call the Ascent Network, or when they call anybody for credit repair, they're calling them, and it's not generally the best time of their life. They're calling them when they walked out of Art's office, they found the dream home, that the home of their dreams that they want to purchase, and Art's had to give them bad news, or the loan originators had to give them bad news of, that 580 credit score is not going to cut it. We're not going to be able to get you that mortgage with a lower down payment in terms that you can afford. Or when they've walked out of a car dealership and their car is broken down, the one that they had is broken down, and they really need to buy a car, but their credit isn't of such that they'll qualify. Or if they do qualify, if they can get a car loan, instead of paying a reasonable rate, the rate is jacked up, is now as high as 25%. It's going up to, they're making car loans at 25% these days to individuals that have poor credit. So unfortunately, there is a much larger portion of people in my industry that I would like that take advantage of people as well, and they prey upon them. Yeah. When they have bad news, they just are concerned about one thing: I'm going to try to park that person with as much money of theirs as I possibly can. So they make promises, and those promises are generally a result of one of two things happening. Either A, they're going to ask the person to do, or propose the person to do, something that in some cases is just flat out illegal. Now, I got to be honest with you. I've not heard this individual that you talked about, that's here locally, I don't pay attention to most of them. So I can't speak specifically for him, but there's an old adage that says if it's too good to be true, if it sounds too good to be true,
Right.
it probably isn't. Well, that's very, very true in the credit repair business. We're the legitimate credit repair industry, and we are a very legitimate industry. Mm-hmm. But the legitimate credit repair industry is governed by 6 different federal acts. We're very heavily regulated. Mm-hmm. And in the state of California, which is where we're domiciled and where you work and live, there's 6 state acts that mirror the federal acts. So there's a lot of people out there that just throw caution to the wind, claim they can make a lot of promises to people who are in dire straits and can't deliver on any of them. And then good luck in 3, 6, 9 months, a year later, when nothing has been done on the file, good luck in tracking that person down.
Right.
That's why I stated earlier that, I've been doing this for 35 years. The Ascent Network has been around since 2009. We couldn't be around that long if we were burning people and taking advantage of people.
Right.
So you just really have to be wary. Now, to get to the crux of your question, what's a realistic expectation? It is true. Our numbers for 2022 going into 2023, the average person that came to us in 2022 saw a credit score increase of 110 points. 110 points. Now, some were higher than that and some were lower than that, but that was the average. The average amount of time that it took for us to achieve those numbers was 6 to 9 months, a 6 to 9 month window. So again, that's due to the regulation that's in place and the process that's set up under the Fair Credit Reporting Act, the Fair Debt Collections Practices Act, and the Credit Services Organizations Act. Those are 3 of the companies or 3 of the acts that have the greatest thing to say about what we do and how we go about doing it.
Well, good. That sounds good in terms of a reasonable expectation as to how long it takes. It just doesn't make sense that somebody can meet one of these other organizations and think that they're going to get drastic improvement in a few weeks or a month or two. That just doesn't make any sense. And whenever I've heard that, I've always told myself that's not the kind of company I would want to refer any of my prospective borrowers to, because they're just going to be set up for failure. So that was good to get that kind of clarification. That 100-point improvement that your company is averaging, 110-point improvement, for a conforming loan, that's huge, because what that means is 100 points in credit score is worth 0.5% in rate on average, which can make obviously a big difference in monthly payment. So given that's the case, I mean, can you this is essentially our last question, but can you give our viewers maybe just a brief some hints as to what steps they can take on their own, even before they maybe engage a company like yours, to try to gain some improvement in their score, kind of get some of that 100-point improvement? What kind of simple steps would you recommend they do just to try to get on the right path?
You better. Well, one of the things that I would recommend a client or a potential client of yours to do is call me. And the reason I say it is I don't want them as a client per se. If they're sitting in front of you and they've got a 676 credit score, and you tell them, oh man, if I could get you, if there was any way I could get you to a 680 today, you would see a drop of rate, or you'd see a reduction in cost. Have that client call me. We're not going to talk to them about becoming a client of Ascent. I've looked at, in the course of my working lifetime in doing this business, I've looked at literally over 1 million credit reports. And I will tell you, nothing surprises me any longer. It's been probably 10, 12, 15 years that I've looked at a credit report, raised my eyebrow and said, wow, I haven't seen that in a while.
I can say the same thing. Yeah.
Yeah. But I also can tell you that I don't know that there's a credit report out there that I haven't looked at in the past 2-3 years that just by looking at that report and telling the client, I'm making some minor changes from the standpoint of notifying the credit bureau on their own. Doesn't have to be anything fancy. Notifying the credit bureau on their own of some small little things. They can find between 8 and 20 points. And that's within a 30-day period. 8 to 20 points. Almost every report I look at, I can guarantee you that I can find that many reports, and those clients, they don't need to be clients of Ascent. I'm not going to charge them. That's why we're a nonprofit. That's one of the reasons why we're a nonprofit, is to give the consultation. One of the benefits that we offer all individuals is what's called financial education and literacy. And that's available to anybody, and there's no cost. Now, are we going to sit on the phone with them for 3 hours and help them complete your application? No, we're not going to do that.
Of course not.
But we are going to counsel them and tell them what needs to be done. One quick thing that I can, and I know time is of the essence here, but one quick thing that I can tell clients to do that oftentimes helps them. Let's say a client comes to you, that client is in the 660, 680 range. You'd really like to get them above 720, because at 720, that is really a sweet spot with conforming loans with a lot of lenders. And if you can get them to that level, let's say, and so that's more than just the 8 to 20 points. They need 30, 40, 50 points. One thing that can be done is generally that individual's credit history with revolving accounts is pretty good. Mm-hmm. You got maybe 2, 3, 4, half a dozen, or a dozen, not a dozen, but maybe 2, 3, 4, 6 different revolving accounts, MasterCards, Visas, and the like, American Express, Discover. Tell the clients if those accounts have aged over 36 months, in other words, if they're 36 months or older, tell the clients to go back to those lenders. And if they've got $5,000 lines of credit, tell them to go to the lender and ask for a credit line increase. A credit line increase. Mm-hmm. Now, that's not to tell the client to go out and spend more money and get further in debt. No. Right. That is simply get higher available credit lines, and then the amount of credit usage that the people have, they don't have to pay anything down.
Right.
The amount of credit usage they have, that goes down, that shrinks, the percentage goes up, and now their scores go up because it shows they're managing their credit better. There's little tricks like that people can do. And like I said, anybody that might be listening to this broadcast today, any client that you might have that needs those little tweaks or says, I don't really get what I just heard on the Mortgage Minute. You talked about something, credit line increase. I don't understand. Have them call me. I promise them one thing. I won't try to sell them anything. I won't ask them to buy anything. I'll simply give them information, because there is nothing more I wish than I didn't have a job. That's the thing I would wish for. And that is, if everyone's credit would rise, everyone would treat their credit responsibly, mm-hmm. and everybody could experience what they want to do in life from a financial nature using credit wisely.
Well, thank you, Aaron. That's great information. And, your offer to even have folks just call you for, brief advice, as you said, you're not going to spend 3 hours on the phone with them, but just the fact that you're willing to do that and share some of these tips, I think that speaks to why you and your company are so successful, and why I'm comfortable and I like the opportunity to be able to refer people to you, because I know they're going to be well taken care of. You're going to deal with them straight. As you said, you're not going to try to sell them anything, and you're going to start off by trying to educate them. So I think that's great. It really speaks to you and your company, and that makes it even more enjoyable to have you on the show today. And all you folks watching and listening, you can see on the screen, for those of you watching, If you do have any interest in getting more information on credit score restoration, repair, credit education, we've got Aaron's phone number on the screen there, 877-871-2400. Feel free to call Aaron to get some help and advice, and maybe sign up with him if you need to go that far. Or if not, I'll be happy, check with me, and I'll be happy to get you connected with Aaron. So Aaron, thanks again for spending the time on the show today. I really appreciate it. Any last words before we move on to the next segment?
Art, thank you very much for having me on the Mortgage Minute. I really, really do appreciate it. And the only thing I've got to say is I just wish you and all of your viewers a very, very happy and blessed Thanksgiving.
Oh, thank you. And happy Thanksgiving to you, Aaron. Thank you.
Take care.
Okay. All right. Take care, Aaron. All right. Now, folks, we're going to go into our next segment, which is our closing question from last week. And here it is on the screen. What additional benefit does the VA Home Loan Program offer to disabled veterans? A lot of folks, I think, are aware of this, but yet a lot of folks are not. Well, if you're a disabled veteran, disabled due to a service-connected disability, what the VA is going to offer you is being exempt from paying the VA funding fee when you get the loan. Now, of course, that begs the question, what is a VA funding fee and what is it for? Well, the way to think about it is, first of all, understand that the VA, the Department of Veteran Affairs, they don't make mortgage loans. Lenders make mortgage loans. And of course, the key feature of a VA loan is no down payment, a zero down payment. What the Department of Veteran Affairs does is they guarantee the loan to ensure to the lender that if the borrower defaults, which can happen because of no down payment, the lender can submit a claim to VA to get reimbursed for the foreclosure loss. So the VA funding fee is the fee paid by the borrower to ensure that guarantee. Now, this amount can range from 1.25% to 3.3% of your loan amount, depending on your down payment and whether you're a first-time user of the VA home loan benefit or you're using it a subsequent time. So the VA funding fee can be a pretty substantial number. And as a consequence, that's why if you are a veteran and you have entitlement for the VA program and you have a disability that is service-connected, you can have that VA funding fee cost waived. And you can get that even if your rating for disability is anywhere from 0 to 100%. So if you have a partial disability, I've encountered borrowers with a 20% disability to 25, 30, you'll still get the exemption. In addition, if you're a surviving spouse of a veteran who died in a service-connected situation, the surviving spouse will also qualify for the exemption if they're going to get a VA loan. So this is good information to know if you are a disabled vet. If you haven't used your VA home loan benefit before, just know that the VA has got your back and they're going to waive that cost if you're going to get that VA loan due to your service-connected disability. With that, let's go to the closing question for next week. And it's regarding cash-out refinancing. And in the cash-out refinancing guidelines, there is an exception made, and it's called a delayed financing exception. So again, you can see the question there regarding a cash-out refinance loan. What is the delayed financing exception? Well, at next week's program, I'll be providing you the answer to that, and it'll be on the house. Jeff, back to you.
Hey, Art. First of all, before I get going, I just want to remind everybody, next Thursday, I think there's something special. I think it's Thanksgiving. And so we're not going to be here for Thanksgiving. We'll be the following week, but we just want you to know we are going to be dark. We're going to be spending time with our families and our friends, and we want you to do the same. But we will not be having a show next Thursday.
Right.
You know, there was a lot of good information there, Art, that I know you have spoken about it, in the past throughout the shows, but it's always valuable when you have an expert who's been doing something as long as Aaron has, comes on and basically, validates almost word for word. It's just, as I was watching, I'm like, wait a second, this is something we've talked about before, but now you have somebody that has the credentials and the fact they're a nonprofit, that's like they're overlooked by the U.S. government that, it's not like I set up and said, I'm going to give credit. So that was pretty impressive. And, what a great tag team you guys make. I love that whole idea of raising your credit in a short period of time by doing some of the techniques. I think that's great you had him on today. Thank you.
Yeah, and that's part of the reason we had him on is because, again, as I mentioned, I've encountered lots of folks in his industry over the years. Most of them I just could sense right from the get-go that they were not of the philosophy that Aaron has established with the Ascent Network. And of course, I think the fact that it's a nonprofit is a big signal too, that that's a company that's going to be highly regulated, which is what you want, because you want to make sure that if you're going to engage in a company like that for those kind of services, you really want to deal with somebody who's legitimate and who can really achieve results, but do so in a realistic way and at a affordable cost, which I think Aaron's company does every single day. So that's why I'm very comfortable referring to him and why I wanted him on the show.
Yeah, I think that's great. Now, before I let you go, I want to address something that is, I think, really important. Is, first of all, according to things that I've been reading, is applications for new loans and not refinancing, but HELOCs are going up. So that's a good news. But one of the things I want you to be aware of is what rate you're paying for a brokerage fee, and not your rate, but it's a rate that is being paid to the brokers. Can you address that and how that affects the cost of a loan for a borrower and where you fall in that?
Yeah, we've actually touched on that before, but yeah, when we deliver a loan to a lender, we have already in advance, when we've engaged with that lender to be approved to deliver loans to them, we have to declare what's called our lender paid compensation. And when we do that, we are generally presented essentially a grid where we will declare our compensation to be paid to us by the lender in an amount equal to somewhere between 1% of the loan amount up to 2.75% of the loan amount. We have historically always been at 1.25%, which is at the low end of that range, obviously. But we are underway with revising our lender paid compensation arrangements with all of our lenders, where we're going to go to a 1% lender paid compensation fee. And again, that's paid to us by the lender when we arrange the loan for the borrower and deliver it to them. Why is that important to the borrower? Well, if you think about it, the lower the lender paid compensation paid to the originator, the better the rate you're going to get. I've talked to many of the wholesale lenders I deliver loans to, and they tell me most of their broker customers have lender paid compensation closer to 2% or more. Some are even at 2.25%, 2.5%. Well, if I'm at 1%, that's going to mean a significantly different rate, lower rate than what you're going to get from another broker who's getting paid, let's say 2 or 2.5%. So we're in the process of gravitating, of changing all of our agreements to that lower level, because we want to, particularly in this high rate environment, we want to put the best rates forward to our borrowers that we possibly can.
I think that's great. So for those of you watching today, and maybe you're watching afterwards, the information for Art is on the screen there, 760-883-5700. That's his office number, or you can call his cell at 714-612-9035. And of course, the website is mwloan.com, where it just has a plethora of information. Hey, what is the rates going on? What kind of calculators are available for you? So those are available. And of course, you can always reach out to art at mwloan.com. Art, great show, great information. I really appreciate it. I want to wish you and your family a very safe and happy holiday as we move into Thanksgiving, and I'll see you next week.
Okay, as to you, same thing, Jeff. Have a happy Thanksgiving. I want to thank Aaron Huebner with the Ascent Network again. And all of you viewers, thank you for listening and watching. I wish you all a happy Thanksgiving next week with your families, and we'll see you in a couple of weeks. So long. Take care.